Ready to pass the CPA exam faster? Visit cpapass.ai. Today, prepare for FAIR, how to classify debt and unrealized losses. Examiners love to trap candidates on where unrealized gains and losses land, specifically whether they hit the income statement or bypass it to sit in equity. When a company purchases debt investments like corporate bonds, the accounting treatment is uniquely driven by management's intent at the date of acquisition. Under US GAAP, this intent dictates which of the three distinct classifications you must use: held to maturity, trading, or available for sale. Misclassifying these at the outset triggers a domino effect, leading to incorrect balance sheet valuations and misstated net income that will cost you easy points on the FAIR exam. To keep these straight under pressure, use the HTTA mnemonic. H is for held to maturity. You hold it to maturity, reporting it at amortized cost. T is for trading. Today's value is what matters, meaning we adjust to fair value through the income statement. A is for available for sale, the alternative path where we adjust to fair value through OCI. To see this in action, let's walk through a scenario where a company experiences a $10,000 unrealized market loss on its debt portfolio. How we account for this drop depends entirely on whether those bonds are classified as trading or available for sale. Before looking at the loss, let's address held to maturity, or HTM securities. HTM requires both the positive intent and financial ability to hold the debt to maturity. Think of an HTM investment as a bank account. When you deposit money, you only care about the principal and the contractual interest you earn over time, not daily market fluctuations. Consequently, HTM securities are reported at amortized cost, adjusting only for premiums or discounts. Temporary market swings are completely ignored on the balance sheet, meaning our $10,000 market drop requires absolutely no journal entry or adjustment. Now, let's apply our $10,000 unrealized loss to trading securities. Trading securities are debt instruments bought for short-term profit. Because they are held for active sale, they must be adjusted to fair value at the end of every reporting period. For our $10,000 loss, we debit unrealized loss on the income statement and credit the fair value adjustment account. This immediately reduces net income and earnings per share. On the balance sheet, the investment is presented at its reduced fair value, reflecting the current market reality because today's value is what matters most for active traders. Next, let's look at the alternative path, available for sale, or AFS, debt securities. If our $10,000 loss occurs on an AFS security, the balance sheet presentation is identical. It is reported at fair value. However, the income statement impact is completely different. Instead of hitting net income, we debit unrealized loss in other comprehensive income, or OCI. This bypasses the income statement entirely, accumulating within equity on the balance sheet. This crucial difference prevents short-term market volatility from distorting operating results when management has not yet committed to selling the debt security. Watch out for these high-yield examiner traps. First, while normal market declines on AFS securities go to OCI, credit losses under the applicable standard must be recognized as an impairment charge directly on the income statement. Do not put credit losses in OCI. Second, never adjust HTM securities to fair value for temporary fluctuations. Keep them at amortized cost. Finally, do not confuse debt rules with equity rules. Equity investments generally have no OCI option and must go through net income. Master these distinctions and practice realistic simulations on cpapass.ai to ensure you are fully prepared to dominate these investment questions on exam day.